Good morning, everyone. We're just waiting for some people to come on. Okay, hello, everyone. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth's Smart Money webinar series. Thank you for joining us today. Our presentation is titled 2021 Review and 2022 Outlook, and will be presented by Brett Greenspan. Next, for those of you that don't know us, Stripmatter Wealth is a registered investment advisor located in sunny downtown Fort Worth, Texas. Our advisors are certified financial planners and fiduciaries specializing in retirement planning, investment management, estate planning, and real estate investing. Today's webinar is meant to be purely educational next, and not meant to as tax or legal advice. Please talk to your licensed professionals before taking any action on the information that's presented. And for more information, including key disclosures, please visit us at our website at stripmatterwealth.com. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please don't hesitate to type those in, and we'll be happy to answer those questions for you. Also, we'll be sending you out a replay of today's webinar via email, so if you missed something, don't panic. You'll have the ability to watch it again. We'll also post it to our website as well. And you are welcome to forward this presentation and any of our presentations to your friends and family if you think it would be beneficial. So without further ado, next, let me introduce our speaker today. His name is Brett Greenspan, and he is with Morningstar Investment Management. Brett is a portfolio specialist and serves as a liaison between portfolio managers and clients. He has over 13 years of industry experience. Brett lives in Florida with his wife and their 2 German Shepherds. So without further ado, I'm going to hand this off to Brett. Good morning, Brett. How are you?
Morning, Josh. How you doing today?
I'm doing great. Thank you for being here.
Appreciate being here, and good morning, good afternoon, everyone. Nice to have an opportunity to speak to you, to give a market update, certainly on a day and a week where we're seeing a lot of volatility out there. So I think this is a timely discussion. And as Josh mentioned, it's really going to be a look back at 2021, kind of talk about some of the drivers of returns, areas where we saw perhaps opportunity, maybe some reversal or continuation of trends, and then just talk a bit about our outlook for 2022, where we're seeing opportunity, both from equity with respect to equities and fixed income, and then just talk about the broader economy as a whole. So I'll kick things off with the capital markets review, and again, I mentioned, with the volatility that we're seeing in the markets right now, I think it's always important to think about a time period to anchor to, and really with respect to the current market environment, with the current trend cycle that we've seen, you can anchor to 2 times. You can go all the way back to 2008, 2009 with the global financial crisis, or more recently, you could go back to Q1 2020 and think about the kind of beginning of COVID-19 and that sort of change in our market expectations. So I'm going to start with the latter here, because I think that really sets the stage for where we've been, where we are now, and where we might be going from here. So I just ask you to think about what you were feeling in the first quarter of 2020. There was tremendous amounts of uncertainty. I'm here in the Chicago area, and around here, it was, we're shut down for 6 weeks, but after 6 weeks, we'll be back in the office. We'll be back out doing everything that we've normally done, and this will all be behind us. And obviously, that couldn't have been further from the truth. And as you often see in times of uncertainty, the market responded really negatively. At the end of the first quarter in 2020, S&P was down just shy of 20%. Small and mid caps, which tend to be a bit more volatile, their balance sheets tend to be perhaps a bit more unstable. Those were down even more, over 30% with respect to U.S. small caps. And also a bit of a breakdown between U.S. growth and U.S. value. And I'm going to touch on that in some more detail in a few slides here. But that's really been a key theme that had been trending in that direction leading up to 2020 and has really blown out since then. You can see U.S. growth, U.S. value, both negative, but U.S. value down significantly more than U.S. growth. On the international side, also the continuation of a trend there with international equities underperforming U.S. equities. And with respect to fixed income, not a ton of places to hide. Obviously, U.S. governments, as people get out of equities, they go into safe havens. That did do its job, which was it was up just shy of 10%, 8% there. And I'll also point you to high yields there, down over 10%. And that's been an area that you've seen a lot of interest as people seek out higher yields. They look to take on a bit more risk in order to generate a bit more income. In environments where you see this sort of risk-off trade, this is a somewhat fair expectation where you might see those riskier assets on the fixed income side underperform. Now, I emphasize this is a really opportune time to talk about this, because at the end of the first quarter, I imagine there was a lot of fear out there as investors. You think, maybe I should get out of the markets. I just don't know where this is going to go from here. Pretty similar to what a lot of us, I would expect, are feeling right now with respect to what's going on in Europe. But over the next 18 months, so from the end of the first quarter, beginning of the second quarter of 2020 through the end of last year, massive returns for equity investors. S&P 500 over that time frame up just shy of 90%. U.S. growth stocks up over 100%. And you see, again, I mentioned that small and mid caps were the laggards in the first quarter. They outperformed their large cap counterparts over the next 18 months. Now, again, that theme, U.S. growth over U.S. value, domestic equities over international equities, that continued. So no surprise there, given what we've seen, given the amount of stimulus that we've had here in the U.S., both fiscal and monetary. That's not to say that there hasn't been stimulus internationally, but it's relatively dwarfed in comparison to what we've seen here in the U.S. So I bring those up just to highlight that those are really two key themes, two key takeaways for what we've seen over the last couple of years, and certainly last year, was that U.S. growth over value and domestic equities over international. Now, on the fixed income side, again, a reversal of that trend I mentioned in Q1. You could call this a risk-on trade, where you saw high yields as people got out of them in Q1. They got way back in the second quarter of 2020, and then all the way through 2021, with almost a 30% return for U.S. high yields. Now, those governments were the safe haven. Those U.S. government bonds were the safe haven in Q1 2020. Over the next 18 months, they actually were in negative territory. And that's compounded a little bit by the fact that we've seen elevated inflation over that time period. So again, just a reminder that there might be a month, there might be a quarter where you see negative performance, uncertainty spikes, but it's important to take a long-term time horizon if you are a long-term investor and not let emotions play a key role in how you're allocating or getting in and out of the markets. So let's look at 2021 in a vacuum. And all things considered, for equity investors, a really strong year, pretty much across the board. S&P 500 up just shy of 29%. This was primarily led by large cap stocks, and we'll touch on those FANGM stocks in a moment here. Those have been and continue to be really strong drivers of performance for the broad market. U.S. mid caps and small caps also had a strong year. I will note that small cap value dramatically outperformed small cap growth. That's partly what we're seeing there in that Morningstar U.S. small cap 16% return there. And, I mentioned when I got started here that we've seen a lot of trends continue. We've perhaps seen some inflection points, reversals. By the end of 2021, we saw U.S. growth and U.S. value within 1% of one another. And that was a massive reversal from 2020. In 2020, U.S. growth relative to U.S. value was up almost 45%. So to see those narrow a bit, to come in neck and neck, it's not necessarily saying this is a definite reversal, but it was certainly a change from the prior year and perhaps a sign of things to come. Obviously, that will play out over the coming quarters and years. Now, again, similar story internationally. Developed Europe lagged the US. I point you to that red among emerging markets. That was somewhat surprising in a sea of green here. You can really point to the weakness in Chinese equities as a key driver of emerging market underperformance there. That was likely playing a significant role in not only the underperformance, but negative performance for emerging markets at large. Now, within fixed income, again, you can see here, not a ton of opportunity, high yields, somewhat attractive there, but in the face of potential rising rates, it's been not a relatively attractive environment for fixed income investors. So that's why you see some red there, even more red among emerging market fixed income. And that's an area I'll touch on a bit later as potentially attractive from a risk reward perspective, but obviously you are taking on additional risk to perhaps reap those rewards. Now, over a trailing 10-year, I wanted to show you this because it's easy to get caught up in one quarter or even a day like we're seeing today. For long-term investors, it helps to take a step back and look at, call it 1 year, 3, 5, or 10 years like you're seeing here, and realize that over the long term, broadly speaking, we've seen equity markets go up. Over the trailing 10 years, talking about 16.5% annualized returns for the S&P 500. It's hard to be upset about that. And again, as you see red all over your TV screens, you get alerts on your phones about the markets crashing, or there's new risk out there. There's downside risk, inflation risk, geopolitical risk. Over the long term, it's helpful to be reminded that we have seen really strong returns and to keep that long-term focus in the face of all these potential distractions. Now, one thing I do want to point out, I mentioned downside risk or perhaps some downside volatility there. This is a metric that does show that perhaps U.S. equity prices are expensive relative to history. So what this metric is showing, this is the Shiller PE ratio, price to earnings ratio. And what this does is it's a cyclically adjusted price to earnings ratio. So it takes the rolling earnings of US companies over the last 10 years. And it does that with a rolling perspective in order to smooth out some of those kind of one-off, huge quarters or huge down quarters. But even taking that rolling number, you can see that at least with respect to our history, we're at pretty elevated prices here. It's right behind the dot-com crisis, and you can see all the way at the back end here, the Great Depression. Now, I'll point out, because this can be a shocking chart to look at, that there is an argument to be made that there's good reason for these elevated prices. We've had unprecedented monetary stimulus, starting in 2009. We've seen it again in 2020 and 2021. We've also got fiscal stimulus. The government has stepped in to prevent, significant downturns, and certainly with respect to COVID. So there's good reason for elevated prices, but there's also the fact that historically speaking, we haven't seen these types of valuations in some time. So I just point that out to give you a perspective about where we are with respect to history. That red line there is showing the historical average over just shy of 90 years here. Now, we've talked a lot about equities. I'll talk about equities a bit more here. This is showing how low treasury yields are historically. Now, this is as of the end of the year. We've actually seen treasury yields tick up closer to 1.9. And that's obviously had a negative impact on some bond prices. Broadly speaking, you can say as yields go up, bond prices go down, and vice versa. So this is another headwind out there, is the specter of rising interest rates, not only for fixed income, but for some of those more growth-oriented equities where their cash flows are being priced out at really low rates. If they have to increase that, the rate at which they're borrowing, that might impact their cash flows discounted to present day. So another thing to keep in mind, even as rates do rise, is that we are at historical lows here. If there's a historical average of 6.1%, even a move from 1.5 to 2% relative to history still puts us definitely below average here. Now, I want to pivot more into equities here, and we're going to just walk through a bit of 2021, pull up the hood, and show you some of the performance with respect to the style box, and then looking at individual sectors. Now, I touched on this earlier, but again, you're seeing a sea of green here. There wasn't a ton of areas that you could be invested in the US and not feel pretty good about your performance last year. The one area that we did see negative performance, and granted it was just negative 1%, but relative to the rest of the market, it certainly was an outlier, and that was small cap growth. Now, one thing that I will point out is that over the last, call it 3 to 5 years, it's definitely been beneficial to be in the growth area of the style box. Specifically, large cap growth has been a key driver. Now, I talked earlier about large cap value narrowing that gap with large cap growth. We also saw mid and small cap value make up a lot of the gap that they'd been seeing relative to their growth counterparts. So just something to keep an eye on. I've got a slide that I'll bring up here in a moment that shows that those are two areas of the style box, mid value and small value, that we still view as quite attractive within the US. Now, pulling up the hood a little bit, looking at sector returns within the S&P 500. Energy, real estate, and financials led the way. I'll point out that energy and financials were two areas that got hit really hard in 2020. We viewed those as quite attractive for long-term investors, given that pullback and given the potential for normalization after that disruption. And that certainly played out with energy, leading the way in a huge way for 2021. We've actually seen that continue into 2022, even prior to the gasoline on this geopolitical issue we're seeing right now. With through January, energy was once again leading the way among U.S. equity sectors. Energy and financials were actually the only positive U.S. equity sectors, S&P 500 sectors rather, through January of 2022. Now, not a ton to be unhappy about, even if you were invested in those laggards, utilities, consumer staples, and industrials. Those still were just shy of 20%. But broadly speaking, we saw a reversal of 2020 trends with energy and financials leading the way. And despite growth and value somewhat narrowing in their performance, you still saw IT and communication services with strong performance at just shy of 35% for IT and communication services at about 22%. Now, I mentioned those two specifically because that's really where these FANGM stocks fall in. And what you've probably heard the FANGM acronym out there, and you see here, it's Facebook, Amazon, Apple, Netflix, Google. I used M as well, which would be Microsoft, but you don't see that one here. And I just include this because it's a tremendous chart showing how strong the performance has been for these stocks. So that blue you see here, this is the return of those stocks since 2017, 365%. That is a massive return that likely outpaces the growth in their profitability. But you can see there's a huge demand for growth out there. There's huge demand for these companies within individual portfolios, within mutual funds, and they've even outpaced the broad sector. I mean, you could own all of information technology, and obviously you're not going to be unhappy with a 280% return. But broadly speaking, this is likely unsustainable performance over a 4-year time horizon, and it dramatically outpaced the S&P 500, which again is no slouch at 113%. So one other chart here to kind of drive home this growth versus value story, this FANGM, this market cap weighted performance. What this is showing is not just US, but all world, MSCI world growth versus value. Value is represented with that green line, growth represented with that gold line. And what you can see here is that they're generally trending pretty close together. This is excess return. So when green is above zero, value is outperformed. When gold is above zero, growth is outperformed. And broadly speaking, they're within, call it 2% of each other. They were historically that way going back to about 1980. You can see in the early 2000s, value dramatically outperformed, but that trend reversed, call it after the global financial crisis in 2009, and has absolutely exploded since 2016. And so I bring this up just to highlight, one, that these are somewhat unprecedented markets, and two, it's helpful. It often helps add perspective to look at a chart like this to say, okay, this is somewhat unprecedented. We can't say when this will end, but historically speaking, these two tend to converge with one another, and perhaps value might be relatively more attractive in this environment than it has been in some time. Now, at a high level, our colleagues on the Morningstar Inc. side view the U.S. equity markets at relatively overvalued, so maybe trading at a 5% premium. That's not to say that there aren't areas or pockets of opportunity. Again, I mentioned mid and small cap as areas that look relatively attractive compared to the broader opportunity set. Growth being slightly more unattractive, specifically mid growth as being an area that we think is maybe trading at a 12% premium. But broadly speaking, you hear all the U.S. markets overvalued. That's painting with a broad brush. For more granular active investors, we certainly think there's an opportunity in certain areas of the style box, and that diversified investors should feel comfortable with U.S. equity exposure. Now, I do also want to show you, this is the CAPE ratio I mentioned earlier. This is including developed Europe and emerging markets. And I bring this up again just to highlight that there has been this kind of dislocation over the last 4 or 5 years between historical averages. So you can see these tracked pretty closely together dating back to about 2010, US CAPE was actually below its historical average up until about 2014 here, where you can see it tracked slightly along it and then really moved a lot higher. Now there was the pullback as COVID came on the scene, and then we've seen those valuations really explode up to historical extremes. Maybe is too strong, but nearly at historical highs here. Again, I touched on some of the reasons earlier about why this may be justified or why there may be legitimate reasons for this move higher. But historically speaking, just looking at the numbers here, we are at historical highs looking at this cyclically adjusted price to earnings ratio. Now, I also want to spend some time talking about fixed income. Obviously, that plays a big part of client portfolios and the broader investment landscape. And I touched on this earlier, but again, this is probably the key theme to keep an eye on is that 10-year treasury and alongside the specter of the Fed funds rate moving higher. I know the Federal Reserve has messaged potentially 3 rate hikes in 2022. They've discussed that first one occurring in March. Obviously, there's a number of variables at play. We're seeing inflation concerns and persistently high inflation, despite some calls that it may be transitory last year. And now we're also seeing this, the geopolitical issues, which adds another component where perhaps it affects commodity prices. We're obviously seeing a pretty significant pullback in some of the some specific equity markets. So whether that affects the Fed's decision to raise rates is obviously going to have an impact on the fixed income market. But you see here, there's not a ton of room for rates to go lower. There's obviously quite a bit of room for rates to go higher from here. I know the Fed is obviously concerned about that affecting broader asset classes and asset prices. So they'd like to do this incrementally, but there's a number of headwinds that they'll have to navigate in order to do so without really affecting the broad market. Now, one more look at the Treasury yield curve here. This is showing you 3 different data points. So the blue is going to be December 31st of 2020. The red line represents about halfway through the year, June 2021. And that silver line represents 12/31 of last year. And so you can see here, the big takeaway here is that those near term, so call it up to about 7 years, you can see those near-term rates or yields ticking quite a bit higher. So just something to keep an eye on. Again, the long-term seems like it's tracking pretty closely, but it's not as simple as just rates go up, bond prices go down, bond prices go up, rates are down. Different areas of the yield curve are going to react differently to rising rates, and that's part of the reason it pays to have some diversification in there, have some balance among your fixed income exposure. Now, it's not just U.S. fixed income that we should be paying attention to. Developed market yields also, may have an allocation within your portfolios, but it's no more attractive internationally than what we've seen in the U.S. We've actually seen some rates internationally go negative, which we haven't seen here in a meaningful way in the U.S. So I know there's often the thought maybe we could go internationally to get our exposure if it's not attractive here, or maybe for international investors looking to the U.S. Broadly speaking, given fiscal developments, given the monetary policy in most of the developed world, rates are at historical lows. And so there's not a ton of opportunity in that fixed income space if you are looking for capital appreciation. It's probably best looked at as a buffer or a hedge against some of your equity exposure. Now, the one area where you might find yields a bit more attractive is in emerging market debt. And I touched on this a bit earlier here, but you can see the yields are quite a bit higher in emerging market debt. And that makes sense, right? These countries, generally their currencies have lower value, their balance sheets may be weaker. So investors ask to be rewarded for that risk. So just something to keep an eye on if you are very income focused, if you are, maybe you don't want to take on any more equity exposure at any cost, but you do need income generated. Perhaps emerging market debt is an area where you can find increased yield relative to US and developed markets. So I do want to finish up with a discussion here, more of a macro discussion about some of the economic signals we're seeing out there and our outlook for 2022. And as you might expect, any discussion about the markets begins with COVID. This has been the biggest market shock we've seen over the last few years. When I first put this presentation together, it was probably mid-January, and this downturn here was not visible. So I was very excited when I pulled the updated slide here to see that we have seen a pretty significant downturn. We've almost certainly hit the peak in most areas with respect to new COVID cases. And that's going to allow for a lot of the major metropolitan areas to open up. I know here in Chicago, they've announced that there will be no more mask mandate. There's a return to offices taking place all over the city. And I think that's taking place in a lot of other metropolitan areas as well. So very encouraging from an economic perspective to see that we do seem to be through the worst of the Omicron peak. Obviously, Omicron came right on the heels of Delta, so I certainly don't want to jinx it and say that there's not another variant that could come out. But right now, it does seem that we're through the worst of this most recent crisis and hopefully well on our way back to normal. Now, with respect to GDP forecasts, we are in line with with consensus out there for 2021 at about 5.6%. And we're actually a bit above consensus through 2025. We view the inflation concerns as probably persistent, but something that we think as supply and demand normalize over the next few years, those inflation concerns should somewhat abate. And that's part of the reason that our estimates are relatively above consensus through 2025. Now, employment is another key issue, or rather unemployment is another thing that's certainly a concern out there. We've got a relatively tight labor market. That U3 figure is what you normally see out there. U6 is reflecting rates of unemployment, underemployed workers out there. And again, these are relatively low. We've seen somewhat change out there right now where there's, given the tight labor market, you're seeing raises for employers, you're seeing people leave jobs. There's been talk of the Great Resignation, but obviously this is playing a part where, depending on where you're located, companies and businesses are having a hard time finding workers. And so making sure that we get back to somewhat normalized unemployment rates and a normal business cycle will certainly contribute to getting back to a typical economic growth and more normal GDP forecasts. Now, I talked a bit earlier about the amount of fiscal and monetary stimulus we've seen, and I think this chart paints a really powerful picture. It shows in 2020 that in 2020 and again in 2021, you'd see a huge red line here as this data gets finalized. We had the largest fiscal stimulus since World War II. So you can see going back here, this is the World War II stimulus as a percentage of the federal deficit relative to GDP. So this was a massive amount of fiscal stimulus on top of the monetary stimulus we were seeing from the Fed. So when I talked about asset prices earlier, this is part of what I was talking about there, that story about it's not just in a vacuum that asset prices are higher. We've had some unprecedented support, both from a fiscal and monetary perspective. And again, this is showing 2020. You'd likely see this figure, if not above what we saw in 2020, then pretty close to it. So back-to-back years of really significant stimulus from the U.S. government. Now, we talked about inflation. This is looking at inflation through the end of the year. So CPI is broad inflation. Core CPI takes out food and energy, which tend to skew the numbers a little bit. But even with that said, core CPI at 5.5%, it's about as high as we've seen it in almost 30 years here. And, we at Morningstar have taken the position that we think it's likely to be a bit more persistent than maybe the Fed had been messaging. Transitory was pretty soft language there, and maybe they didn't forecast that there could be other variants that got into the way. But really, the biggest issue that we've seen is that the supply chains have struggled to normalize in the face of these back-to-back variants and in the face of renewed shutdowns, whether it's in the U.S. or in China or some of our counterparts where we're supplying overseas that are still targeting a zero COVID environment. It's been really hard to normalize supply chains, and certainly relative to demand, where we've seen demand really spike both for services and goods. So that's really the key driver behind what we're seeing in inflation right now. And part of the reason that we do think that over the course of the next, call it 2 years, those should start to normalize and maybe not get back to 2% right away, but certainly come off what have been these historical highs, or certainly the highs of the last 30 years. So in terms of our market outlook, again, we think that with continued vaccine distribution, we've seen natural immunity given the infection rates here in the US. We think that we're likely through the worst of Omicron, but are obviously wary of potential new variants. But broadly speaking, we're bullish on the economy. We think that GDP should continue to grow. And again, we are above estimates in 2023 and beyond. So we're forecasting about 5.5% this year, just shy of 4% next year, and strength into 2025. Now, with respect to the U.S. market, again, maybe a 5% premium on prices. That was in January. That's probably even a bit lower here, given the pullback we've seen. But we do think that there are areas of opportunity. Small value, mid value, even large value relative to the growth side of the style box we view as attractive. And then looking under the hood, energy and financials still remain attractive, despite the strong performance they've had over the last 15 months. We do think, and obviously some of this is playing out, that there are potential pitfalls of, say, index-based, market-weighted approaches, some of those FANGM stocks that have had that significant outperformance and are now experiencing some pullbacks, something to be wary of as you view your diversification and position sizing. And just highlighting the fact that, in an environment like this, where there's a number of headwinds, there's a number of risks out there, granular positioning within a diversified portfolio is likely going to be helpful. Taking an active approach and modifying and modulating your exposures based on your risk tolerance. And then again, with respect to interest rates, fixed income, we've got our eyes peeled for that first rate hike, whether it's going to be in March, whether it's going to be pushed in the face of some of these adverse headwinds that we're seeing out there. And also just keeping an eye on the Fed's tapering. They started tapering late into last year, but it was pretty modest, 5-10 billion in the face of what was about 120 billion a month. So we're curious if that's going to pick up in pace prior to a rate hike, or if those two will work in conjunction with one another, as it's still quite stimulative approach for the markets. So I'll pause there, and Josh, I'll hand it back to you as we move forward here.
Thank you, Brett. Great presentation. And we're going to take some questions, but I'm going to wrap this up, and then we'll take some questions after. But first of all, again, I want to thank you, Brett, for such a great job. And as you see on the screen here, if you have any questions, you're welcome to give us a call at 817-210-3444, or just email us at clientservice@stripmatterwealth.com. Also, sign up for our weekly market updates, e-newsletters for up-to-date market information and analysis. And then join us as we do our radio show every Saturday at 10 a.m. on 1190 a.m., where we answer your financial questions. So again, folks, thanks for coming. We're going to answer some questions. And there's some disclosure slides for you. Hopefully you got all that.